This is episode 9 of Trading Bot Sessions, where I talk with traders who have built automated trading strategies and trade everything from stocks and options to futures and crypto. In this session, I speak with Kyle Schultz, founder and lead developer of the trading systems found on his site algorithmicfutures.com. Kyle has over 10 years of experience in a variety of investment roles, including investment banking, private equity, and hedge fund research. Prior to founding Algorithmic Futures, Kyle led alternative manager research at Jackson National Asset Management. Kyle and I cover many important topics on the development of algorithmic trading in futures, including his early experiences in developing strategies in R and Python, building a business around selling future strategies, where to find inspiration for ideas, and how to rigorously backtest future strategies. This is Mike Christensen, co-founder of TradersPost, and I trust you'll enjoy this episode of Trading Bot Sessions with Kyle Schultz. Well, Kyle, thanks very much for joining me here today. I'm really excited to learn a bit about your background as an algorithmic trader and the types of services you provide in the space. Maybe you can get us started with just a bit about your background and your career and how you got into finance.
Yeah, thanks, Mike. I appreciate you having me on. So I'll start with, I'm the founder and lead developer at Algorithmic Futures. That's my current trading firm, but I'll give a little bit about my background. I'm originally from Chicago. Chicago's a huge trading system city just because you've got the CME and the CBOE there. So there's a lot of prop trading firms, hedge funds, and traders in the city. And so I grew up in Chicago, and really there was a lot of buzz around trading. I had some of my brother's friends were traders at different prop trading firms, and I was interested in it. I went to undergrad at University of Iowa and ended up working in investment consulting and hedge fund manager research right after undergrad. I think at the time, prop trading firms were moving from using discretionary traders to really just hiring programmers. So I wasn't able to break into prop trading right out of undergrad, but it was a pivotal shift in the industry. And so I gained a lot of interest in automating trading and kind of recognized that I need to develop a skill set to become an algorithmic trader versus, the discretionary traders of the 80s and 90s, right? So I cut my teeth in investment consulting, and I was allocating capital to different hedge funds for one of the world's largest insurance companies, Jackson National, which was interesting because I was sitting across the table from Brevin Howard, AQR, some of the largest hedge funds, and really just soaking it up and learning as much as I could from them. But ultimately, deep down, I wanted to be on the other side of the table, investing and trading directly. So I ended up going back to business school at UCLA. That's what brought me out to LA, where I reside currently. And during business school is when I developed and learned R programming language for some of my data analytics classes. And right away, I started backtesting strategies once I learned it. So I was fascinated with it and kind of got the bug from there. And right after business school, I worked in private equity and was investing capital into companies, lower middle market companies, mostly growth equity, but also some buyouts and whatnot. And then had a stint in investment banking. But all of that time, I had been developing backtesting and learning different trading strategies. Then I stumbled across the TradeStation platform. And that's currently what we use for algorithmic futures. And I'm sure some of your listeners are familiar with it, but we can dig into that and how I use it, and then how we develop different portfolios at algorithmic futures for our customers.
Yeah, sure. Well, maybe sort of going backward just a little bit there, can you tell us a little bit about your early learning experience with developing algorithmic strategies? Did you have any real big successes there and any failures that you learned from?
Oh yeah, plenty of failures, less successes, but that's the journey of a trader, right? Because sticking through the failures are incredibly important. So when I first started developing strategies, I was using R, and I was pulling data from Quandl into R. While I was in business school, a friend of mine, we had plans to start a hedge fund based on a trading strategy I developed, trading iron condors in equity index options. And we needed someone to backtest the strategy. So we hired a MFE, Masters of Financial Engineering student, to backtest it in R, because I was really just a beginner in R. And to be honest, that's where I learned most of my R program, is working directly with him to backtest the strategy. Little did I know that using options data there's so many different metrics that you're looking at with options data, from the Greeks to different strikes to different maturities. So it's a lot of data to synthesize into R. And then on top of that, I was using an iron condor trade, which is a four-legged trade where you're selling a call spread and a put spread. And then, you would typically roll the strategy or let it expire worthless. It's a strategy that performs best in sideways markets. So that was my first foray into developing strategies in R. And the problem with that is I was trading it manually, even though I back tested the strategy, and I would have my setup in Excel. And then when a signal hit, I would enter into the trade manually. And I always wanted to automate this, and I was going to develop an automated system in Python or R. But ultimately, once I discovered TradeStation, I was like, wow, this is, incredibly useful and helpful. You can have an all-in-one backtesting platform, optimization platform, and algorithmic trading system. And then, your data is right there. I'm not calling from Quandl. It's a closed environment. So once I stumbled into TradeStation, then I really used easy language to program all the strategies. But the one thing I learned is that it's very difficult to automate option trading strategies because when you look at the bid-ask spreads, they're pretty wide. You can't guarantee execution, especially in high volatility. So for a lot of different reasons, I moved away from option trading strategies. And at that time, I had started researching intraday momentum strategies and started developing most of the strategies on intraday momentum and some mean reversion, mid-frequency mean reversion. And those are some of the strategies that I still use today in algorithmic futures. So learned a lot through synthesizing a large amount of options data into R and Python versus using TradeStation, which is 80-20 Pareto principle, gets the job done. There's some bugs with TradeStation, but it's a really good platform. And then two, I learned that options-based strategies are very difficult to automate. I'm sure there's a lot of market makers and other ways to trade them, but if you want to guarantee execution, it gets very difficult, and it's something that I've kind of strayed away from.
Yeah, I can see that. And I think we've noticed among our users at TradersPost that many people are shifting to futures for similar reasons. Even traders I know of that have been trading options for years now have started to use futures and are pleasantly surprised by it. So you said that you've got some intraday momentum strategies that you're running even today in futures. Can you tell us a little bit about the strategies and what markets you're trading there?
Yeah, so I think intraday momentum strategies are one of the holy grails of trading. And the main reason for that is they tend to perform best during periods of high volatility, which is what you want, right? If you're just looking for beta strategies, you can get that in the market. Short-term trading strategies that benefit from high volatility can really offset any other beta you have in your portfolio. And then you capitalize on some crisis alpha, as I would call it. So there's a lot of different ways to look at momentum. You can look at different look back periods. You can look at opening gaps, opening range breakouts. Those are some basic type of strategies. And we utilize a lot of those, but just kind of, those are simple approaches, but it's really how you refine them, the other filters you're adding, what time of the day are you trading them? When are you looking for a confirmation signal? For example, the market might gap up huge, but you need a confirmation signal that momentum is going to continue throughout the day. Otherwise, there's periods like today where the market rallied for the first 2 hours of the day and then completely reversed. So we've had some pretty choppy markets. So you want to be able to avoid the choppiness and then have very strong confirmation signals on when to enter into trades. So we trade those primarily in equity index futures.
Got it. Mainly ES, NQ?
Yes, primarily ES, but I've also developed strategies in NQ, RTY, and YM, which is Dow, Russell 2000, and NASDAQ futures.
And when you're creating filters around volatility or looking for high volatility moments, is that based on realized volatility, or are you looking at implied volatility from the VIX or from the options market?
Yeah, so we're typically not using volatility as a filter. I was just trying to say that the strategy actually tends to perform best during periods of high volatility, right? So there's that old adage, the market takes the escalator up and the elevator down, right? So we move up slowly and then very violently the market can turn and you can capture some short momentum when there's periods of market crisis. So I was just kind of alluding to the fact that those periods are big money makers for those types of strategies. But you also have the ability to benefit from up market momentum as well. So it's not just like a vol capture type strategy. It's a really balanced approach to trading. You just really have to avoid the market choppiness like we're experiencing over the past couple of days.
Sure.
Yeah. But I think there are some, I'll also mention, I think there are some really good filters to use, whether it's like the ADX filter, which is a momentum-based indicator. And then I've looked at, MACD, RSI, other technical indicators, but most of the time I'm really just trading price action. What's the gap up? What's the range breakout? How has the momentum been over the past 30 minutes, hour and 30 minutes, right?
Have you had success in gaining confirmation from looking at higher time intervals as well, like yesterday's high and low, or even the week's high and low?
Yeah, sometimes I'll use those as entry points. And then also I might use a limit order based on a certain look back period of like the highest and low of the last 12 bars or something.
Sure.
So I think using price action like that is really helpful because ultimately support and resistance levels and different price levels, they are psychologically good points of entry and exit for different strategies. So I do like to reference historical bars, historical highs and lows of different daily bars and whatnot.
Good to know. Do you find yourself referencing the DOM at all?
No, I don't really do that. And I don't really use, one thing I want to look into is using more volume-based indicators. Because right now I'm just using price action. I think volume could be a very good secondary indicator to use that could kind of supplement some of the price action. I think you get pretty good signals from higher volume price action versus low volume price action.
Sure. Would you be considering indicators, sort of classical indicators like on balance volume or other volume indicators that have been around for a while?
Yeah, I haven't. I was looking into some different indices for volume. I haven't done a ton of research there yet. That's just kind of on my list of things to do.
I see. So you're really referring to indices that offer more of a market breadth indicator on overall market volume.
Yep. Yeah, that'd be the way to put it. Yeah.
Gotcha. So I understand you have a platform called algorithmicfutures.com in which you sell access to existing strategies in the futures market. Can you tell us a little bit about that and what your focus is there?
Sure. So we've got 5 different portfolios at Algorithmic Futures with account sizes ranging from 15K to 65K. So it's pretty accessible for even smaller traders. And these are portfolios of different futures-based strategies. So uncorrelated strategies combined into a portfolio. And really what we're offering is customers can subscribe to our systems. So we offer a monthly, quarterly, or annual subscription. And it's a completely hands-off way to trade the market. So you set up a TradeStation account, and then our broker, the Fox Group, we have our system set up on the remote server and they trade directly into your account. So for customers that, are interested in trading or maybe want to supplement their own trading with someone else's strategies, they can be really great to supplement, right? So we offer those in 5 different portfolios, and they are a variety of strategies that trade commodity trend following, E-mini, mean reversion, and intraday momentum. We have some currency momentum strategies, but we're putting the portfolios together with different strategies so that we can have uncorrelated returns together to help reduce drawdowns and drive returns, right? And really what we're trying to do is create consistent performance, whether it's a bear market or bull market in the equity markets. So some of our systems did incredibly well last year, even though we had a pretty rough year in the S&P 500.
That's good to hear. And I guess a big part of that is really diversifying your approach across multiple markets. You mentioned commodities and the indices, and as well as some other of the markets. Are you finding that when you develop this diversification, that you're measuring the correlation of these markets sort of on the fly, or is what's your look back period for measuring correlation?
Yeah, so I mean, correlation, I think there's two things, is like we think about diversification from a lot of different perspectives. So there's one, the market you're trading. There's your trading style. Is it momentum? Is it mean reversion? Is it unrelated to that? Is it trend following? So there's like a lot of different strategies, and then also diversifying by time frame. So there's a couple different ways you can increase your level of diversification. There's always, if you're looking at the risk return statistics, obviously the correlation number is very useful. But when I'm doing back tests and combining them into a portfolio, what I'm really looking at is during periods of high volatility, were the strategies offsetting to each other? Did they help reduce the drawdown? And I think you really got to double click into some of the, like, look at the worst days, what happened on those days, what trades went off. Because if you're just using monthly risk return statistics, it's a good to look at the correlation 0 or the correlation is negative. But that's really a high level understanding of how the strategies relate to each other. It's best to double click on certain days when they performed really well or really bad, and understand what happened, what went on that day. Because it's one thing to back test, optimize, and develop different trading strategies in a portfolio on paper, right? And then when you're trading it live, when things don't go well, you might start to question your strategies, right? So it's important to develop robust strategies, but it's also important to understand your strategies and how they'll react during different market cycles and events, so that when something bad happens, you're not questioning your strategy. You're saying, hey, this is kind of part of the risk that I set up in the strategy. And, I feel comfortable with the risk level it's at, and we'll continue to trade it, because otherwise you're tweaking your strategies and you're changing them all the time. And really, that can hurt your performance. And you're really just kind of convincing yourself, looking at a back test, that you're going to have the same performance going forward. So it's important to develop robust back tests.
Yeah, I appreciate you saying that. When you're selecting these big market events, is there any criteria you look for historically? Do you have like a whole list of events that have occurred in the past that you typically measure against?
Yeah, I think the number one thing I look at is just different volatility events, right? Mm-hmm. So when you think of volatility, there's prolonged volatility, and then there's sudden volatility. And I like to look at all the different volatility events, because they are always different, right? And the ones in the future are going to be different as the ones in the past. We had a period in March and April where the market dropped 35% within a month, right? Because of COVID. You had a flash crash in May 2010, where it was a one-day crash. You have prolonged bear markets like the tech bubble, like 2008 and the financial crisis, and potentially like we're seeing now, where we also have the fastest rate increase in history, mm-hmm. and really high inflation as well. So I really try to look at all the different types of volatility events to understand how the strategies will perform, because they will perform differently in each of those volatility events. So the VIX might spike to 40, 50, 60. That's just one data point. That doesn't tell you, what type of market you're necessarily in, right? So I try to characterize the market by how long has the drawdown been occurring, and how deep is it?
Do you have any advice on how one might come up with good ideas to test a new type of strategy, momentum, mean reverting, or otherwise?
Yeah, honestly, I gain a lot of inspiration just from reading both research reports, like white papers that have been published by different academics and PhDs in the industry. Like I said, I began my career researching different hedge funds, and they put out a lot of research, and that kind of got my wheels spinning to develop different strategies. But Also, there's plenty of books, resources, videos, and stuff on the internet. And I'm not saying that you should rely on those strategies that are published, but they could get the wheels turning and help you think about different setups, different entries, different exits, certain markets to look at. So really, I just spend a lot of time reading, looking at different strategies, and then kind of leverage my background and experience in different hedge fund type strategies.
Given that there's so many different places to build strategies now, and many of our users are on TradingView, do you have an opinion around what the minimum requirements are for backtesting a strategy to be robust and truly rigorous?
Well, I would say that I use very long back test periods, but I think more important than the length of time is making sure you walk forward the analysis, because, and the reason I use long periods of time is I want to see a strategy that's consistent throughout different market cycles, events, and regimes. And oftentimes those regimes can be very long, right? We just went through a 14, 15-year period of quantitative easing where interest rates were zero, but that's not necessarily the environment we're going to have over the next 10 years. And in fact, it's going to be probably very different, right? It's going to be more like the 70s when we had pretty high inflation and the Fed had to hike interest rates pretty quickly, sent the market into a recession. You know, you had the oil embargo in 74. And so there's a lot of volatility in those types of markets. So really, you have to be able to look at a back test that's been through a couple different market cycles and regimes. So I use very long time periods. So I would say that try to use as long as possible, but really understand what's going on during different market cycles and events. And then make sure you're walking forward the back test. And I use like a cluster walk forward analysis in TradeStation because I want to try to vary up the in sample and out of sample period when I walk it forward, right? Because I think even using just an 80% in sample, 20% out of sample, it can really cause overfitting as well. And just doing the analysis and researching different strategies, walking them forward, and understanding how the strategies change is very insightful. So yeah.
Can you describe a bit of the mechanism that TradeStation uses to create that clustering and how one might try to emulate that?
So TradeStation has a built-in function for walk forward analysis. And like I said, you might use an in sample and out of sample period. And what they do is they optimize the strategy. They might cut up, say you're doing a 10-year back test, they might cut up the back test into 5 different periods with an in sample and out of sample, and you're optimizing to each of those periods and walking it forward, right? So the most robust signals will be consistent over all of those time periods. And then taking it one step, and there's a bunch of different metrics that TradeStation uses to show whether it passed or failed the walk forward under different in sample and out of sample periods. So they have those set up, and you can change them, or you could use the standard metrics. But I would suggest looking into those, and then you can take it one step forward and vary the in sample and out of sample period with a cluster walk forward, which I think is just, it's another layer of testing that I think creates a little bit more robustness. But I'm sure there's other platforms out there. Like I said, TradeStation really has everything built in, which makes everything a lot easier, in my opinion.
Yeah, they also offer a much longer period of time to test the history of futures prices, which unfortunately can't be found on TradingView at the moment. The farthest you tend to be able to go back is about a year on most futures contracts. So for intraday strategies, that seems to be pretty good depending on the number of trades you take, but nowhere near as effective as a 10-year backtest. So maybe the part of my question there is leading to this idea of how can you create a more effective backtest with a shorter period of time to test from?
Yeah, I would say, so sorry, you're just asking how you can create robust back tests with short time periods?
Yeah, have you run into that constraint before?
I would say, I would say the best way to do that is to not use too many parameters. Because when you're using too many parameters, that increases your probability of overfitting the backtest. And then the second thing is, and this is a little bit more art than science, right? I mean, we kind of walk through what you should do from a walk forward perspective, but when you tweak those parameters, if it's significantly changing your backtest, that's a good signal that it's probably overfit, right? Because you wouldn't want to see huge deviations when you're tweaking some of the parameters just slightly. It means that if that's the case, then you overfit to that specific time period. So those are some more intuitive ways that I use just to kind of figure out whether a strategy is robust or not. But there's a lot of different tools, and you got to combine them together. And there's not just I think there's the more research you can do and the more different ways you can utilize the test robustness, the more helpful it is. Some people do stress testing, Monte Carlo analysis. So there's a variety of different ways, but I tend to use walk forward analysis and use very long periods of time. But you bring up a good point, because like I heard TradingView also, you might use signals from one market in another market. For example, you might use implied volatility of option prices for an equity signal. So really, if you're creating a little bit more complex back tests, there's a lot of things you can't just do directly in TradingView, as I understand.
That's true. Yeah, I think to vary something like that up, you'll have to access the data outside of it, and then trust that the trades would be executed correctly on TradingView after doing your backtest in a separate environment.
Right.
So in your opinion, given what has changed in markets, especially as of late, you mentioned, the market regime changing to something closer to what it was in the 70s. What are the biggest challenges that algorithmic traders face today, given this new potential regime?
So what I've seen is an ability to adapt towards bearish markets and choppy markets, right? So a lot of my intraday momentum strategies perform best when the markets are trending intraday, obviously. And what we've seen lately is very mean reverting markets, where the markets will jump up or jump down very quickly. So you want to make sure that your strategies are not entering into trades during those types of markets. And then two, I think that the strategies that have performed really well, and maybe some types of strategies that your audience could look into, are commodity trend following strategies. We went through a period during quantitative easing where these strategies tended to not perform well. A lot of trend following strategies had a tough decade, but now we're back in a market regime with high inflation and higher interest rates. And the commodity markets are trending very strongly because of that. So I would definitely look into adding those types of strategies to your portfolio. Sure. But it's going to be, I think, a little bit choppier than it has been for the past decade, right? When interest rates are zero and the market's pretty much in a significant bull market over that time period. There's volatility events, but it seemed like the market had a buy the dip approach to trading, and that doesn't necessarily work anymore.
Makes sense to me, and I think many people are experiencing that now, given how choppy and mean reverting things seem to be right now. So with the potential of some of these commodities markets being more trend following, do you have some that specifically that you're eyeing, oil or softs, meats? Which commodity markets in general?
Yeah, no, I try to take a pretty diversified approach towards it. It's hard to, each market is very specific, right, to the supply and demand dynamics to that market, and also the use cases for that market, right? So gold, softs, livestock, there's going to be different market dynamics. And so if you take a trend following approach, I think you should really spread it around across markets, which we do. We trade in currency futures, we trade in lean hogs, we trade in gold, we trade in cotton. So there's a variety of different markets we use, and the benefit of that is trend following strategies tend to have a lower hit ratio, meaning that you're going to get stopped out a lot, but then when you do hit, your gains are significant, right? So those types of strategies are choppy in their own sense because they're not consistent performers. But when you combine them all together in different markets, it helps create more consistent performance, in my opinion.
Sure. Well, I know we're kind of close for time here, so maybe we wrap up from here. Is there anything you can share about how people can get in touch with you and how they might be able to reach you for any questions they might have on your expertise, and then also anything more about algorithmicfutures.com?
Yeah, so I would first check out the website. It's www.algorithmic-futures.com. So there's a dash in there. And like I said, we offer 5 different portfolios. So you can poke around and try to understand what the different strategies are and what the historical performance has been for those portfolios. And then if anyone has any questions, they can email me at info@algorithmic-futures.com. And I'm glad to answer any questions or chat with anyone that has interest in the systems or learning more about algorithmic trading in general.
That's great. I appreciate that. I'll put those in the show notes as well, and look forward to maybe doing another one of these with you. I appreciate the info.
Yeah, absolutely. I appreciate you having me on, and I hope it was helpful for a lot of your audience.
I'm sure it will be. Thank you.
All right. Thanks, Mike.